On behalf of Capital Trust Research Private Limited, it gives me immense pleasure to welcome you to a Q&A session. We will answer your popular questions on the Colombo stock market and its growth prospects against the backdrop of the current economic challenges. Capital Trust Securities is ranked number 1 in the calendar year 2021 in terms of transaction turnover and brokerage turnover. Capital Trust Securities is also ranked number 1 in the financial year 2021-22 in terms of transaction turnover and brokerage turnover. Capital Trust Securities possesses probably the largest local client base in the Colombo Stock Exchange, as it had executed the largest number of transactions in the Colombo Stock Exchange last month. Today's webinar is the 16th of a continuous series of webinars that Capital Trust Holdings Group will be conducting on listed company sectors, the macroeconomy, the market outlook, technical analysis, and real estate. Capital Trust Research Private Limited has been in the forefront in correctly identifying early high growth stocks that have generated significant outperformance during the pandemic conditions as a result of the continuous healthcare depreciation and import restrictions. The stocks covered by its research reports and webinars have helped its clients to make over 200% returns year to date and kept the Colombo Stock Exchange very active. Now we are pleased to introduce Mrs. Divya Kasichetti, Head of Corporate Finance of Capital Trust Partners Private Limited, Mr. Hasita Liyanage, Head of Research of Capital Trust Research Private Limited, Ms. Imalka Hettiarachchi, Senior Research Analyst, Ms. Rcl Valuation, Senior Research Analyst, Mr. Rakesh Sharma, DGM of Capital Trust Securities, and myself, Shehan Mendis, AGM of Capital Trust Securities. So over to you, Divya, to give a brief update of fundamentally attractive stocks that we are covering.
Thanks, Shehan. Let's have a quick look at the market dynamics within the logistics space. The price per container on the China-US East Coast route, one of the world's busiest container lanes as at end August, was stable. However, has climbed over 438%, with Asia to US West Coast route rates increasing by 499% compared to the previous year. Congested ports in China and North Europe, likewise, have kept Asia to Europe rates at record levels, 8 times greater this year compared to last year, but stable in this month. Ocean freight rates are trending upwards in September, with capacity constraints continuing, with container shortages, shipping constraints, and port congestions. In addition, the increased demand owing to increasing orders from retailers ahead of the peak US shopping season is expected to add a further strain to global supply chains. In response to increased demand, although ocean carriers have increased trans-Pacific capacity by approximately 22%, limitations in increasing port capacity has resulted in new record number of vessels waiting for days outside LA Long Beach for a berth to open. Extreme ocean costs, delays, as well as new rail disruptions in the US have many importers. So as we mentioned, the ocean rates remain elevated. Moving on to air freights, the extreme ocean costs, delays, as well as new rail disruptions in the US have many importers considering air cargo as an alternative. Surge in trans-Pacific air freight rates are witnessed. This is owing to US seasonal demand and COVID-19 cases disrupting operations at China's main air freight export hub of Shanghai. Though operations are improving at Shanghai's Pudong Airport, COVID-related disruptions are having a big impact on air cargo capacity and rates. The rates are 4 times higher than pre-pandemic levels out of China to the US, and ground handling at many US air cargo hubs are overwhelmed as well, with shipments arriving at major airports, including Chicago's O'Hare Airport, being stuck for days. Average Shanghai to North America spot rates hit $9.74 per kilogram, a 22% jump from last week, and 3 times the pre-pandemic 2019 levels, according to the Baltic Air Index. The rate is the highest it has been since May 2020. Rates from Shanghai to North Europe also spiked to their highest level this year at $5.73 per kilogram, up 27% over last week and 155% over 2019. As mentioned in our previous webinar, the company is actively looking at acquisition opportunities to expand their reach. This has worked very well for them in the recent past and will be a key growth strategy going forward in order to build capabilities and infrastructure, and thereby expand portfolio of services offered to customers. EFL Global Logistics Limited in Singapore, a fully owned subsidiary of Tjalanka Holdings PLC, acquired Complete Transport System LLC for $6.1 million on the 8th of September 2021. The US-based company offers bonded container freight station and trucking services. The acquisition allows Expo to strengthen its service offering by providing value-added logistics services. This acquisition supported the company in filling their gaps in the destination market US and expand their service portfolio to customers. Facilities such as this in congested marketplaces gives them an edge and further improves service offerings to customers. This follows the previous acquisition of Idea Logistics LLC, a Central American logistics company headquartered in the United States with presence in El Salvador, Nicaragua, Dominican Republic, Haiti, Guatemala, and Honduras. This acquisition gave them an opportunity to build infrastructure capabilities immediately, which usually takes years to build. With this acquisition, they control both sides of the supply chain, origin as well as destination, and thereby expanding their reach and enabling them to further deepen wallet share with key strategic accounts. As mentioned previously, inorganic expansions through acquisitions will be actively pursued by the company. Results for financial year 22 and 23 are also expected to benefit from Expo's expansion-driven growth strategy. The parent company, with a 75.62% shareholding, SG Holdings Global, will arrange low-cost funds to fund acquisitions as and when the need arises. Our forecast remains unchanged from the previous webinar, with revenue forecasted at 411.63 billion rupees in financial year 22 and 534.54 billion rupees in financial year 23. EBIT margins remains in line with our previous forecast at 9.5% for the logistics sector from the second to the fourth quarter of financial year 22. Given that passenger capacity could see a pickup in financial year 23 and slight easing of capacity supply constraints, freight rates may marginally reduce. Accordingly, we conservatively forecast that EBIT margins will decline to 7.8% in financial year 23. As a result of the strain from the leisure and investment sectors, the EBIT margins at a consolidated level are forecasted at 8.89% and 7.73% in financial year 22 and 23 respectively. Net profit attributable to equity holders is forecasted at 30.67 billion rupees in financial year 22. This translates to 106.84% over the previous year. In financial year 23, net profit after tax to equity holders is forecasted at 34.76 billion rupees, reflecting a year-on-year growth of 13.32% over financial year 22 forecast. Our forecasts are conservative for financial year 22, given the prevailing market conditions and exposed position in key markets. We have also not factored in the additional contribution from the recent acquisitions. We need to relook at the financial year 23 forecast figures at a future date, as the market conditions are dynamic and keep changing on a weekly and monthly basis. Having spoken to multiple industry experts, there is limited visibility to forecast or predict the market conditions for financial year 23 just yet. Moving on to the valuations, Expo is valued attractively at 10.85 times financial year 22 forecasted earnings and 9.57 times financial year 23 forecasted earnings. Having looked at Expo's global peers in the current operating environment, they are trading at an average of a forward PE of 18.01 times. We have considered Deutsche Post, Kuehne+Nagel International, Expeditors, FedEx Corporation, and C.H. Robinson Worldwide as the global peers. In line with our previous webinar and research reports, our valuations remain unchanged at this point in time, resulting in a fair value of 170 rupees per share. We will review and revise the earnings upon assessing the second quarter results once released. We believe the company should continue to record strong growth quarter on quarter, with the second quarter and third quarter being stronger than the first quarter performance, given the increased US demand ahead of the main shopping season, elevated rates, and the value and contribution brought about through the recent acquisitions. We are very confident that it is likely that there will be an upward revision in earnings given the prevailing market conditions, with the market remaining tight and rates remaining elevated. The assigned PER is a 39.87% discount to its peers. Let's move on to Brown's Investments. Since our last webinar, BIL has increased its total stake in HNB to 16.4% of the total issued capital. This was done by acquiring 9.99% of HNB's voting and balance from non-voting shares. Due to the current COVID situation in the country, along with the extended lockdowns, the Chinese delegation's visit to Sri Lanka has been postponed, but the work related to the project is ongoing and on track. As mentioned in our last presentation, bargain purchases of several local real estate and foreign real estate is expected to be finalized in this year. BIL is also continuously exploring and concluding bargain purchases of local companies and strategic stakes, which will boost the P&L and balance sheet and boost net earnings attributable to equity holders amounting to 15 billion rupees. Brown's Engineering Limited is expected to be highly profitable in the future by focusing on telecom and water projects. With organic and inorganic growth, it is forecasted to contribute 1 billion rupees in net earnings to equity holders. The net earnings attributable to equity holders is forecasted at 16 billion rupees in financial year 22, with an impressive return on equity of 23.6%. The stock is currently trading at a PER of 8.35 times financial year 22 net earnings and a PBV of 1.35 times. As mentioned in our previous webinar, BIL's land and property base amounts to 112 billion rupees, denominated in both US dollars and LKR. It is expected that BIL will benefit from revaluations and foreign exchange gains, boosting total comprehensive income in future years. We forecast the revaluation gain in financial year 22 to occur in the fourth quarter, amounting to 5 billion rupees. It is important to note that over 67 billion rupees worth of net assets are in US dollars, largely located in Sierra Leone and Maldives. We maintain our depreciation assumptions discussed previously, even though the central bank has brought in a cap on the exchange rate. We will have to review the effectiveness of such a policy change and impact on the USD liquidity in the banking system as a result. We will review the same in the future and update our depreciation assumptions accordingly. We maintain a forecasted foreign exchange translation gain amounting to 10 billion rupees. Due to the continuously depreciating rupee and the exposure to real estate, it is expected that foreign exchange gains and revaluation gains will recur each year. Therefore, it is important to look at various PER multiples, including other comprehensive income, for comparison purposes. The total comprehensive income attributable to equity holders is forecasted at 31 billion rupees in financial year 22, with a significant return on equity of 45.72%. The stock is currently trading at a PER of 4.31 financial year 22 forecasted total comprehensive income, and 1.35 times price to book value. Now let's move on to Bill's parent company, LOLC. As mentioned in our previous presentation, a holding company, LOLC Asia, will be in Singapore to umbrella the microfinance subsidiaries, LOLC Ceylon Limited, which will hold controlling stakes in LOFC, CLC, and NIFL. Two companies in Philippines, one each in Indonesia and Pakistan. Subsequently, a private placement is planned and will result in large capital gains for the company. As mentioned before, the private placement partner has agreed to proceed with the investment. As stated in our previous webinar, LOLC announced that they made 3 parallel investments in Tajikistan in Central Asia, as well as Malawi and Tanzania in East Africa. The company made its first investment in the Central Asian region through an acquisition of a 75% stake in Parat, a company involved in microlending and gold loan businesses in Tajikistan. LOLC will increase its equity stake in the company to 100% by the year end. The company also expanded its presence in Africa through strategic acquisitions of 2 microfinance companies in Malawi and Tanzania. In Malawi, the group acquired 100% equity stake of Express Credit Limited. In Tanzania, the group secured a 96% stake of Tujijeng Tanzania Limited. LOLC's effective holding in BIL is 53.81%. This results in an effective net earnings attributable to equity holders amounting to 8.61 billion rupees from BIL. The total net attributable to equity holders is forecasted at 55.27 billion in financial year 22. The net earnings of 55.27 billion rupees consists of 25 billion rupees from recurring cash flow, 21.66 billion rupees from the impending Prasak sale, and 8.61 billion rupees from BIL. This will result in a significant return on equity of 40.64%. The stock currently trades at a PER of 4.58 times FY22 net earnings and a PBV of 1.15 times. Similar to what we discussed earlier, due to the continuously depreciating rupee and a high exposure to real estate model followed by the company, it is expected that translation gains and revaluation gains will recur each year. Therefore, it is important to look at various PER multiples, including OCI. LOLC Holdings PLC is a group with the largest land, property, and equipment base in USD and LKR, valued at 179 billion rupees. It will benefit from revaluations and exchange gains due to the rupee depreciation. We forecast the revaluation gain to amount to 10 billion rupees in the fourth quarter of financial year 22. Foreign assets are estimated to be over 100 billion rupees. Similar to what we mentioned with regards to BIL, we maintain our depreciation assumptions and we will review them in the future. We maintain our forecasted foreign exchange gain amounting to 20 billion rupees. The total comprehensive income attributable to equity holders is forecasted as 85.27 billion rupees in financial year 22. This will be the highest recorded by any company in Sri Lanka in a given financial year. The return on equity will be a staggering 62.69% if we account for TCI. The stock is currently trading at a PER of 2.97 times financial year 22 earnings, considering the total comprehensive income, and 1.15 times financial year 22 price to book value. Let's have a look at the tile sector. Since our last update on the tile sector, there have been a few developments across the companies that should be noted. As per discussions with distributors and showrooms, similar to the last lockdown, sales and pre-orders generated across RCL, LWL, and tile remain unaffected by lockdowns. The sales for the month of August remain strong and in line with expectations. The pre-order pipeline remains strong despite the recent lockdown. Over the last month, the pre-order wait list has increased from 10 weeks to 12 weeks. RCL and LWL have now finalized the company's capacity expansions. RCL will be adding 3,000 square meter capacity additions by July 2022, in line with what was mentioned at our previous webinar. Since our last webinar, there has been a new development with Lanka wall taps as per management. Previously, it was assumed that only 1,500 square meters per day capacity addition will be added in financial year 23. But now, another 4,000 square meter addition is expected by end of December 2022. This addition was only expected to be finalized in financial year 23. With this addition, it is expected that domestic manufacturers will be able to handle 100% of the required demand in Sri Lanka. We have not updated our financial year 23 forecast with this new development and have not accounted for the 4,000 square meter a day capacity addition. Accordingly, our forecasts remain conservative. Looking at the Rcl valuation, we have maintained our forecast and projections in line with what was stated at our previous webinar. The counter currently trades at a PER of 6.9.
I think we had a small technical failure again. So we kindly request you all to patiently wait until we resolve that issue. We'll be back very soon.
Moving on to the Lwl valuation. We have maintained financial year 22 and 23 earnings forecasts in line with our previous webinar. The counter currently trades at a PER of 6.2 times financial year 22 and 5.3 times financial year 23 respectively. The fair value of 102.25 is based on a PER of 9 times financial year 22 earnings, which is a discount to RCL and the market. Our financial year 23 forecasts are conservative, as we have not accounted for the 4,000 square meter per day capacity addition expected in the fourth quarter of financial year 23. It can be justified that LWL should trade at a higher PE multiple given the expected growth in earnings. The dividend yield continues to be very attractive at 6.46% and 7.55% for financial year 22 and 23 respectively. As mentioned before, due to only accounting for the capex expansion to kick in the second quarter of financial year 23, we forecast a 15.17% growth in revenue in financial year 23 to 33.95 billion rupees and profits attributable to equity holders to increase by 16.95% in financial year 23 to reach 3.62 billion rupees. Given the 40% dividend payout ratio, dividend yields are attractive at 7.55% based on financial year 23. Looking at Tile Valuation, we have maintained financial year 22 and 23 earnings forecast in line with our previous webinar. The counter currently trades at a PER of 6.33 times financial year 22 earnings and 5.46 times financial year 23 earnings respectively. The fair value of 94 rupees and 10 cents is based on a PER of 9 times financial year 22 earnings, similar to LWL. The dividend yield continues to be attractive at 6.32% and 7.32% for financial year 22 and 23 respectively. As mentioned before, we have assumed a capacity addition of 1,200 square meters to kick in by June 2022. We forecast a 19.59% growth in revenue in financial year 23 to 14.06 billion rupees and profits attributable to equity holders to increase by 15.95% in financial year 23 to increase to 3.21 billion rupees. Given the 40% dividend payout ratio, we are forecasting a very attractive 7.32% dividend yield based on financial year 23 forecasted earnings. Let's have a look at the Swiss tech valuation. We have maintained financial year 22 and 23 earnings forecast in line with our previous webinar. The counter currently trades at a PER of 6.3 times financial year 22 earnings and 5.68 times financial year 23 earnings respectively. The fair value of 34 rupees and 80 cents is based on a PER of 8 times financial year 22 forecasted earnings, which is a discount to Tile and LWL, given that the counter is less liquid. The dividend yield continues to be attractive at 6.35% and 7.04% for financial year 22 and 23 respectively. As mentioned before, due to the increase in raw materials, the profit after tax attributable to equity holders is expected to remain flat in financial year 22 compared to financial year 21, which was recorded at 595.5 million rupees. We forecast a 10.8% growth in profit after tax attributable to equity holders in financial year 23 to 660 million. Given the 40% dividend payout ratio, we are forecasting a very attractive 6.35% dividend yield based on financial year 22 forecasted earnings. Moving on to DIP Products PLC. The operating environment for DIP largely remains the same since our last webinar. Ability of sourcing raw material through imports are largely unaffected as the company has the necessary foreign currency required for settlement of import bills. Demand for medical and disposable gloves remains strong, with COVID resurgence and ASPs remain elevated. Our forecasts remain unchanged since our last webinar, with revenue forecasted at 72.54 billion rupees in financial year 22. Revenue growth is supported by volume growth through capacity enhancements, high capacity utilization, elevated average selling prices, and currency depreciation. As discussed at our previous webinar, demand on medical gloves remains strong, with ASPs expecting to be at elevated levels through financial year 22 and the first half of financial year 23. ASPs for industrial gloves are holding strong, although some pressure is witnessed as key markets US and EU have adequate inventory at hand. Revenue in financial year 23 is forecasted at 85.99 billion rupees, considering the volume growth through the gradual increase of capacity by 12 to 15%, and expectation that industrial gloves should pick up in financial year 23, given the expected uptick in economic activity. Further, value-added products within the supported glove segment, which are high value that generate high margins, are expected to increase from 5% to 15% of their portfolio in financial year 23. Raw material prices are expected to increase over the next quarter and thereafter ease in financial year 23. Accordingly, for the hand protection sector, we have forecasted the full year EBIT margins to be higher than the first quarter, averaging at 10.9% for financial year 22, with an improvement to 11.2% in financial year 23. A marginal dip in tea prices are expected in the latter half of financial year 22 and 23. Accordingly, margins for the plantation sector are expected to ease and estimated at average of 9.5% for financial year 22 and 25 basis points lower at 9.25% in financial year 23. At a consolidated level, EBIT margins are forecasted at 10.56% in financial year 22, with a marginal increase to 10.62% in financial year 23. Net profit attributable to equity holders is forecasted at 5.24 billion rupees for financial year 22. This reflects an increase of 1.54% year on year. The net profit attributable to equity holders for financial year 23 is forecasted at 6.2 billion rupees, reflecting a 18.2% growth year on year. DIPT is currently undervalued, trading at 6.67 times financial year 22 forecasted earnings and 5.64 times financial year 23 forecasted earnings. The price to earnings ratio has been arrived at considering both the market price PER and the comparable export-oriented company PERs. Our valuation methodology remains unchanged from the previous webinar and research reports. Accordingly, we assign a PER multiple of 9 times financial year 22 forecasted earnings, deriving a fair value of 78 rupees and 80 cents, providing an upside of 34.93%. Given the expected dividend payout of 40%, we expect DIPT to record attractive dividend yields of 6% and 7.09% for financial year 22 and 23 respectively. Now let's move on to Haley's Fabric. Since our last webinar, it is our understanding that there is no material change in the operating environment. The companies have been successful in managing operations despite the resurgence of the COVID wave. The company is not hampered by the restrictions on imports as they have sufficient foreign currency to settle the necessary import bills. We maintain our forecast in line with the latest report released. Accordingly, considering the first quarter performance and the fast-paced turnaround of SAT, which generated profits within the first month of acquisition, revenue is forecasted at 27.15 billion rupees in financial year 22, reflecting a year-on-year growth of 83.84%. A price increase is expected in the second half of financial year 22. Considering the increased capacity of 15% coming into the SAT facility and the increased ASPs, revenue has been forecasted at 32.5 billion rupees in financial year 23, reflecting a year-on-year growth of 19.7%. The order book is full over the next 2 quarters, with both manufacturing facilities expecting to be operated at full capacity. The investment will upgrade machinery and technology of SAT to bring the facility on par with MGT, enabling them to obtain direct orders from Tier 1 brands. We expect the financial year 22 forecasted gross profit margins to average at 14.54% and increase by 58 basis points to 15.11% in financial year 23. We believe that these margins are sustainable given the effective cost management strategies adopted. Further, as price contracts are fixed for a period of 6 months, the company books 75% of the raw materials 6 months in advance, enabling them to manage margin fluctuations to a greater extent. EBIT is expected to grow 120.54% year-on-year to 1.96 billion rupees and 42.91% year-on-year to 2.8 billion rupees in financial year 22 and 23 respectively. EBIT margins are expected to be at 7.23% and 8.63% in financial year 22 and 23 respectively. Net earnings forecast for financial year 22 remains at 1.54 billion rupees, which is a year-on-year increase of 109.5% and 2.14 billion rupees in financial year 23. We believe that the forecasts are conservative as we have not accounted for the tax savings arising from the accelerated depreciation on the $8 million capex. Moving on to the valuations, MGT is currently undervalued, trading at 6.42 times financial year 23 earnings. Our valuation methodology remains unchanged from the previous research report, and we continue to assign a fair value based on a PER of 9 times on FY23 forecasted earnings. This results in a fair value of 46 rupees and 40 cents, providing an upside of 40.18%. The PER valuation multiple has been arrived considering the market PER and the comparable export-oriented company PERs. The financial year 23 earnings have been considered when arriving at the fair value, as we believe financial year 22 will be a year of transition, as the company will be restructuring the operations of MGT and SAT, and further machinery upgrades will materialize in financial year 23. We expect a dividend payout of 40%, resulting in a 4.49% dividend yield during financial year 22 and an attractive 6.23% in financial year 23. Moving on to Tjalanka. As per management, the company continues to operate the factories in Sri Lanka and India without any disruptions, despite the resurgence of the COVID wave. Order book remains strong ahead of the seasonal US demand. Management is expecting raw materials, cotton prices to come down from October onwards, considering the new crop. Our forecasts remain unchanged, with revenue forecasted at 49.69 billion rupees in financial year 22. We have assumed that the growth will primarily stem from volume growth across key strategic brands and further supported through currency depreciation. 20% of the capacity enhancement is expected to come into effect in the fourth quarter of financial year 22, with the balance in early financial year 23. The company has already started outsourcing some of the orders owing to the increased demand from these strategic accounts. Considering the enhanced capacities, the group is expected to record revenue of 61.39 billion rupees in financial year 23, a growth of 23.55% year-on-year. Gross profit margins are expected to continue to be under pressure. However, a marginal decline in raw material prices is anticipated. Accordingly, gross profit margins are expected to improve over the next few quarters, with margins expected to be at 9.87% in financial year 22 and touch 10.5% in financial year 23. Although raw material prices may ease with the new cotton crop expected in October-November, it will remain elevated. Over the next quarters, the group will increase prices to customers on new programs, which should positively impact the margins. Operating margins are expected to be lower than the past at 6.46% and 7.53% in financial year 22 and 23 respectively. Significant top-line growth is expected to mitigate the adverse impact arising from the pressure on gross margins. Profit after tax attributable to equity holders is expected to grow by 22.36% year-on-year to 2.62 billion rupees in financial year 22 and 40.35% year-on-year to 3.67 billion rupees in financial year 23, led by strong revenue growth. The capacity increase to support the key strategic brands, Nike and Uniqlo, in financial year 22 and 23, and growth in some of the larger Indian domestic brands, along with the average selling price increases to support higher raw material costs, are expected to be the key pillars of growth. Tjalanka is currently undervalued, trading at 8.1 times financial year 23 forecasted earnings. Our valuation remains unchanged from our previous webinar at a fair value of 51 rupees, providing an upside of 22.89%. The company trades at a premium to its local peer MGT. This premium is justified given the sheer size of the facility, its regional footprint, and higher liquidity levels of the counter. In line with our previous update, the financial year 23 earnings have been considered when arriving at the fair value. We expect a dividend payout of 76.54% in line with the 2-year historic average payout, resulting in 6.73% dividend yield during financial year 22 and an attractive 9.45% in financial year 23.
And we can start off the Q&A session. With that, we have Divya, Hasita, Tjalanka, Rakesh with us. Myself and Rakesh will be taking up the questions that have come up during the session. So, Rakesh, would you like to start off the session?
Yeah, Shekhan. I'll take up the first question. Divya, thank you for the valuable updates about the counters that we are covering. And first question I would like to ask is, I think this is the most wanted question right now. Economy is facing many challenges. However, all share index reached all-time high of 9,300, but dropped to 8,865 within last couple of days. Is the market overheated right now?
Let's have a look at this slide, Rakesh. So one should not look at all 286 stocks in the market or the all share price index. It is important to focus on shares which do not mirror the Sri Lankan economy, which is undergoing several challenges at present. While acknowledging that the Sri Lankan economy is facing challenges, we believe that in order to maximize gains and mitigate the impact of macroeconomic risks, it is important to invest in dollars or dollar assets. And if you are not able to do so because of exchange control restrictions, then you will still be able to benefit by investing in companies which have dollar assets or dollar revenues through the Colombo Stock Exchange. This will allow to protect yourself from the negative impact of rupee depreciation.
Maybe now, just to ask a further question on that. Again, a lot of people have the question, like, is the market expensive at the moment? Is the Colombo Stock Exchange an expensive market? What do you think?
Right. So Shahan, the market can be valued in a few ways. Let's look at the market PE ratios reflected in this slide. So the graph reflects the PE ratios from 2010 onwards. In 2010, it was 20.7 times. And at present, the market PER is only 10.75 times. Let's look at the market PE ratios compared to our regional peers. The current price to earnings ratio of the Colombo Stock Exchange is highly attractive at 10.75 times and is one of the cheapest among the regional and frontier market peers, including India, where PE is at 30.2 times, Bangladesh at 15.7 times, Vietnam at 16.1 times, although Pakistan is trading at a lower PE at 9.86 times. Now let's also look at the price to book value. In 2010, it was 3.3 times, and now it is 1.24 times. Let's see the price to book value of regional peers. Even when looking at the price to book value ratio, the CSE is the cheapest among the regional and frontier market peers, apart from Pakistan, with a PBV at 1.24 times. India's PBV is at 3.7 times, Bangladesh at 2.77 times, and Vietnam at 2.38 times. Despite the market valuations remaining attractive, however, our investment philosophy, though, is not to buy the market, but to buy fundamentally strong and highly liquid stocks that are attractive from a valuation standpoint. I hope that answers your question.
Yeah, thank you. Basically, like for me, the takeaways from what you said was one is that true, we are facing, the economy is facing challenges, but we are focusing on certain counters that we are confident. And unlike in 2011, according to the slide you showed, the market P's and the valuations are still quite attractive given the total earnings. And even if you compare it with the regional peers, it looks very attractive. Yeah.
Yeah, exactly, Shan. It's actually very attractive in comparison to regional peers and where we were trading previously.
Right, Divya, if that is the case, why aren't foreign institutions are buying those fundamentally sound counters? If you really see, I think last 6 months, of course, more than 45 billion foreign outflows, net outflows, if I'm not mistaken. Foreign institutions are continuously selling. How severe it is?
Yeah. So Rakesh, let's have a look at what the outflows are like. So the net foreign outflows from Jan 2020 is about 93 billion rupees. So we do acknowledge that the foreign investment is needed for a small stock market like ours. Foreign institutions generally buy when it is lucrative and sell when it is not. Given that they generally adopt a top-down approach when evaluating the market and stocks they enter, we may continue to see foreign outflow of funds given the prevailing macroeconomic conditions and the rupee depreciation. However, it is noteworthy that the foreign portfolio investors have taken out more from the market than what they have invested. The net foreign outflow from Jan 2010 to date is over 78 billion rupees. This shows that our stock market is not overly dependent on the foreign portfolio investments.
Also, I have a question like, is the local investor participation now very high? Like, is this a retail rally, which is now this retail rally, is it a stable thing at the moment?
Yes, Shehan, actually, it is very stable. So let's have a look at the local foreign participation mix. So if you see in 2010, the local participation was 89.1%. In 2011, it was 75.1%. Then it dropped from 2015 to 2019 to below 65%. Today, the local participation has gone up to over 93.6%. So we understand that there is 7 trillion of official fixed deposits in banks and finance companies. In addition, there may be around 3 trillion in unofficial fixed deposits in unlicensed companies. So with Treasury bill interest rates coming down to the 6% levels and the fixed deposit rates generally ranging between 4.5 to 6%, we find that these maturity proceeds are coming daily into the stock market. Due to the inability of investors to buy stocks in foreign markets and the inability to buy commodities like gold, copper, iron, investors do not have other alternative investments that give double-digit returns. So whenever there has been a sell-off, investors do not take their money out of the market, but merely reinvested the funds again in the market after a few days. We have seen this trend in the recent past as well.
Divya, most of my clients used to ask me, what are the dividend paying counters? Rakesh, please tell me dividend paying counters. I want to invest in those counters. But in the weekly stock focus, why have you given certain high dividend yield stocks sell recommendation?
Right. So Rakesh, let's have a look at the high dividend stocks and their price to book values. So the companies such as distilleries, Nestle, Chevron, and CTC. So, I mean, we do agree that high dividend stocks are suitable or preferred by clients who are more risk averse. But what you need to consider is the total return, that is the capital gain plus the dividend. This is similar to buying an investment property. You don't just buy the property for a rental yield of 6%. You buy the property mainly considering the capital appreciation of over 25% and the rental yield of 6%. In the same way, you need to look at the total return when you are buying stocks and investment properties.
There's another question on the recent policy rate announcement. Based on that, I believe the question is, Sri Lanka has started tightening monetary policy. Interest rates have increased by 50 basis points. Sri Lanka continues to do so. Will it negatively impact on the stock market? I think it's a very fair question to ask.
Yeah, sure. So even if interest rates may be increased, say, by another 50 basis points, let's look at the possible returns for investors if they opt to keep their funds in bank fixed deposits. So let's just have a look at this slide. Right. So if we just take a look at this slide, even if interest rates may be increased by 50 basis points, we can see that the 12-month fixed deposit gives a return of 4.5%, which after adjusting for 18% tax, you will get a return of only 3.69%. There is no withholding tax now that is applicable at present on the FD. Also, when you just have a look at the commercial bank 12 months fixed deposit rates, it has dropped from 11% in November 2018 to 4.5% in January 2021. Even in the event that the bank interest rates rise to 5.5%, then the interest after taxation is still only 4.5%. This is far below the Sri Lankan individual mindset, which demands a fixed return of double digits. As such, we believe that funds will consequently not move from stocks to fixed deposits. Also, this graph reflects that stocks have continued to record strong performance during a low interest rate regime, and we expect this to continue. If you look at this graph, the PLR has dropped from 11.83% in September 2018 to 6.28%. The benefits of such low interest rates for the stock market is twofold. Firstly, companies will benefit from low cost, cheaper funding that will drive investment and record higher profits. Secondly, equity portfolios will also be able to generate increased returns by borrowing at low interest rates, leveraging their portfolios through margin trading to purchase stocks.
Divya, you would have known that last Tuesday, Central Bank has issued a guideline to commercial banks and NSB to maintain the exchange rate between 200 to 203. Will this affect the earnings of the companies that you are recommending?
Yeah, so Rakesh, as per industry personnel, the Forex market has remained largely inactive following the request by central bank to keep the US dollar exchange rate at a maximum of 203 rupees. So prior to this, as per our understanding, there have been instances where import bills were settled at rates much higher than these levels. So while understanding the need of maintaining the exchange rate at these levels, given that Sri Lanka is a net importer and the high level of foreign currency denominated debt, In reality, the ability of maintaining at these levels is dependent on significant inflows of foreign currency to the market. On the demand side, the central bank has taken measures to further curb demand of foreign currency through the requirement of ensuring that 100% of non-interest bearing cash margins are maintained on importation of certain goods. In terms of reporting earnings, most companies with dollarized revenue streams prepare the set of accounts in US dollars or the functional currency applicable, and then translates this to Sri Lankan rupees for local statutory requirements. As such, revenue and costs are stated based on the average exchange rate for the period, and the monetary assets and liabilities denominated in foreign currencies are translated at the spot rate prevailing at the reporting period. So considering the uncertainty on the rate at these levels, we will adopt a wait-and-see approach. We have not amended our forecast assumption. So the average exchange rate of 215 rupees has been used for financial year 22. Sorry, Rakesh, were you saying something else?
No, that's the exact question that I would like to ask. Those 215 is the rate that you have used.
Yes,
you have
correct.
Taken till 2022 March.
Yes, correct.
Okay, that is probably about 7.5% depreciation from the current exchange rate.
Yes.
Okay.
So just to ask a further question on that, Divya, is there a change in your recommendation to protect yourself from LKR depreciation and or money printing?
So actually not really, Shehan. We're still sticking to our same investment philosophy. So what we believe is in order to maximize your investment returns, despite the expected rupee depreciation, we continue to recommend the following: to buy companies with dollarized assets and dollar earnings and benefit from exchange gains, buy companies with real estate, as foreigners would pay more in rupees with the same amount of dollars. Therefore, they will benefit from revaluations and increases in net asset value. Borrow now and invest, as you will be repaying the same amount of capital in rupees in a few years, but that capital will have much less purchasing power. So our investment philosophy largely remains the same.
Divya, you have been recommending companies with large amount of real estates. Why?
Okay. So Rakesh, real estate is an asset that provides a very good hedge against inflation, as it holds and even appreciates its value over a period of time. So let's see how commodity prices have risen to answer that question. As you can see, iron ore has significantly appreciated over 536.6% from end of 2015 to date. The commodity has also increased by 154.5% from March 2022 to date. The same trend is also reflected in copper, with the commodity appreciating 174.29% from end of 2015 onwards, with it appreciating 92.87% from March 2020 to date. Aluminium too has appreciated by 137% from November 2015 onwards, with 63.99% appreciation witnessed from March 2020 to date. So I think, these sort of graphs actually speaks for themselves. So that is why we feel that real estate is an asset that does provide a very good hedge against inflation, as it holds its value and even appreciates its value over a period of time.
Rakesh, there are some general questions also, which are not research specific, but I think probably someone from the trading division should answer these questions, some of these general questions that are coming in, which is still important, I think, to have a good view about the market, because certain other factors also affect the market. Is there a possibility for us to get Tushan also, I think Tushan will have to take some of these questions because it's more suited to get someone from the trading division.
Thank you, Tushan. Tushan, I would like to first initiate a question. If you see last 3 working days, market has come down by roughly 400 to 500 points. Why? Why all of a sudden there was a bloodbath?
Well, any market does not go in a straight line. Periodically, it is healthy that there is corrections, which some call a correction a pullback. Pullback means when it comes very much to the other side, like a bow and arrow, it goes more the next time. So these corrections are very healthy because rather than no correction and a very big drop, we need periodic corrections so that investors who have overbought get flushed out of the system, and the selling which is there gets cleared so that the market can go to the next level once again. Whatever happens, fundamentals prevail. Various people can put out various rumors through social media, WhatsApp groups, news items, but end of the day, more and more participants in the market would create a proper market where there is proper demand and supply, price discovery happens, and finally, each share will react to fundamentals. So we as a stockbroking firm, in my morning meetings, what I tell my stockbrokers, always, you pick out shares with a P ratio of like 5, 6 of reputed large cap companies, which are willing to give us research meetings so that we really know what is happening in the company. We don't, like in 2012, blindly look at audited financial statements and later find that something else has happened in the company. It has to be companies which constantly, communicate with us with the market changes. So my way of doing things is that I want our investors to follow our research, and our research is a set of information and ratios which are with a lot of responsibility done. We are always conservative, and we do not recommend any shares beyond the average broader market P ratio. We are only finding gems which are much below so that they react when after we find the gem, it reacts to the promotion and it goes towards the P ratio of 9 for medium-sized companies and market P ratio of 10.75 if it is a larger company. We are not going to speculate on rumors or on various insistence of investors. In fact, I have got calls telling, such and such a company, why are you revising the market price, the fair value 1 rupee lower. I say I have nothing to do. It's all mathematical done by the research unit. And what has to be told has to be told. Far as the correction last week is concerned, it's like, you get the Elliott-Pave theory. If something goes up 100, there should be a correction of about 33% of it. Markets don't go as a straight line. So it's good that these corrections happen periodically so that the overboughtness goes out and the market can go to and another thing what I want to say is we have never come and said that Sri Lankan economy and the foreign exchange status is rosy.
Tushar? Right. Until we get connected to Tushar, I think we can ask a question from Hasita. Hasita?
Hi, Rakesh. Sorry, if I'm a bit out of breath, so my voice goes a bit wonky. Please excuse me.
No problem. Hasita, a very important question that I should ask from you is that if you see, there has been a lot of criticism about Lanka's fair value. You know why? Because they say it's about 10 times or 12 times price to book value. It's trading at a higher price to book value. Even though you are talking about a PE ratio, they are thinking on the side of price to book value. Would you like to say something about that?
Sure, Rakesh. So I think on our forecasted earnings for Expo for FY22, it's trading at around 6.5 times forecasted book value for FY22 and around 4.25 for FY23, if I'm not mistaken. So it is high, but it's also important to look at competitors and global peers for the industry, for example. So we have given in our previous research, we have looked at some global peers like Kuhn and Nagel, for example, in the US. They are trading at a PBV of around 15 times at the moment. Expeditors, which is the closest competitor to Expo, is trading at 6.75 times, if I'm not mistaken. Then C.H. Robinson again is above 6. The US industry is trading above 7 times book value for this logistics space. So this whole business model is asset light, high cash flow driven models. So yes, compared to certain other sectors, it has a higher PBV, but it's nothing unusual in the sector. And even now, what they're looking at is reducing the PBV. The sector is looking at reducing the net asset value even more by selling certain assets and leasing it back. So that will reduce the PBV, but it will ensure cash flow is positive. So that is the business model, is nothing unusual. It's an industry global norm. So I don't think it's fair to look at, as I said in the last webinar, it's not really fair to look at the PBV multiples compared to other sectors for Expo and the logistics space.
Tushan, there's another question that I would like to ask is, recently passed tax amnesty bill. What is the effect of the tax amnesty bill on the stock market investors?
Well, I don't think the entire public and the investors have realized how great this is. So, in my entire 30-year career, I found that there is a large number of retail clients who don't go to margin trading banks or finance companies. I don't know why, but it may be something to do with not having tax files or something like that. So whatever said and done, this is a great thing. This tax amnesty bill, it has been spoken of in the last 10 years. And this time, this bill, investors could apply before 31st March 2022. And they could attach in the form their share portfolio or margin trading facility, account statement and portfolio. They will get a reply within 1 month. and still the forms and the procedures are not out. What investors simply have to do is, for their entire past tax, they have to pay 1% of the market value of the portfolio as a final tax uh, for all taxes not paid. So it's a deal where you pay 1% for all taxes, and it's not an amnesty like in 2004 where you got something free, and there might have been a possibility that another government comes and changes it. This has been passed by the Supreme Court with the necessary amendments, and the Parliament did those respective amendments, and now it's law.
Okay. Also, Tushan, there's a popular question that most investors are actually worried about. I think you've been there in the market from the 90s, being a veteran in the market. I think you're more suited to give a very clear idea about this question. Is a stock market controlled by an elite member, like by a club with few people where they buy up shares and manipulate it? Can it be manipulated like that, looking at the current context?
Well, the stock market started in 1985, and initially, people were walking around with share certificates, a few transactions, few people were involved. However, with 1997, automated trading systems came in, and brokers used to place their orders from the stockbroking firms. Then 2003, we saw basically Capital Trust with A-Trade. We started online trading, and it has evolved. And specifically after the present Securities Exchange Commission came, they correctly digitalized the account opening process. So all in all, what has happened is the stock market, which was between, we'll say, 2015 and 2019, which was about average turnover of about 300 million on most days. Now, last week, we had a turnover of more than 10 billion, right? Which means it's more than 33 times the market has become bigger. In our firm alone, we have 2,400 concurrent users every day through login 1 and login 2. We are operating as two broking firms as far as online trading is concerned, and there is many hundreds more coming in. There is a large amount of research put out by many stockbroking firms. There is many chat channels. And what we are doing is we are empowering the clients. We are not telling the clients what to do. What we are doing is we are giving a platform so that they can place their own orders, and we are giving guidance through fundamental analysis charts. The companies which are fundamentally sound, large, credible, and who are willing to give us some guidance on what their future plans are. On those companies, we do research reports and webinars, and we openly put it in the Capital Trust YouTube channel. So we empower the clients. We don't tell clients what to do. The clients have to take their final decision, and with all these research material Capital Trust is putting, other broking firms are putting, they can make a proper decision. And what we are further doing is we are giving the fundamentals of the best shares with an in-depth view. And then once they select the fundamental shares, we give guidance through technical signals. By every day, if there are suitable signals, we send at about 11:10 a.m. so that clients know what the technicals like, horoscopes, which is a science, show. It doesn't mean that the sciences are wrong. Sometimes a huge amount of people can overrule the science also, right? But overall, it is a guidance. So what I'm trying to say is the definition in economic textbooks of a market is you have a very large amount of participants. Then there is the demand and supply for shares will determine the proper market price. So a 300 million market was one thing, but a 10 billion market is another thing. It's a proper market where a group of people can't manipulate whatsoever, right? And that's it. Then also I need to tell investors, we have grown a lot after last 1 year. 90% of the accounts are opened within 15 minutes by the CSE app. Then from this month, foreign individuals can also open accounts through the CSE app. There is more than 2 million diaspora living, and with the returns we are giving, they'll obviously be very happy to come in. Then somebody will say, no, foreigners will be scared, the foreign individual will be scared about depreciation. No, you can bring the money and put it in a special deposit account for 12 months and get a interest rate of even 7% from certain leading commercial banks. And not only that, you can borrow 90% of it in rupees and do what you want. Then also you take, there is eConnect under services in the CSE app. You can update your details and see that your bank information so that dividends automatically goes and your payments come to your bank account. Then finally, we also, the market is very efficient because the stock exchange has requested stockbroking firms to put their research reports and videos in the CSE app, which Capital Trust does. So we have completely empowered the clients with the proper information so that they take a proper decision and they do not have to get prompted by any article or stockbroker even. I hope there is a proper market which continues and there is stability.
Yeah, Tushan, there's another question that I would like to ask from you, widely asked question also now. There has been some messages circulating in the social media saying that connected party is selling, right? The share that Capital Trust recommends, the connected parties are selling. There has been messages circulating in the social media. Would you like to make any comment about it?
Well, I mean, it's a very simple thing. Shareholder list, various stockbroking firms and investors are obtaining. You can categorically see the shares which Capital Trust has recommended. The controlling interests are intact and the connected parties are intact, right? And as far as Capital Trust Holdings is concerned, we have bought more and more shares as and when there is additional funds on the shares which have been recommended by Capital Trust Research, basically showing that we believe in our research. We are confident to put large amounts of money and it's just not, research is not just done for academic purposes. We are doing it with a lot of responsibility because at the end of the day, we are putting our money and we are net buyers in those shares and we don't see any other shares which are far better to, in the near future to sell these shares at all. I think one of the misunderstandings which is happening is that, Capital Trust has the largest market share presently. So which means any share, if you take the buying quantity and the selling quantity which comes, capital trust arithmetically has to be the highest. Further, if you take the shares which are recommending, maybe when you look at the shareholders list, our clients have majority of the shares, sometimes more than 75% of the shares. So obviously, when it comes to if somebody buys some share, there is a very high probability it's a capital trust seller. But what they don't realize is when it comes to buying, there is much more being bought, right? Which a person who is buying doesn't also sell and see at that same moment is the other side also capital trust. And then there is as I told you, on one given day, there is 2,500 online users in our company, and very much more waiting to come in. So what is not understood is that there is so many clients who we don't instruct or control. So it's not the main shareholder of capital trust securities who is buying or selling each and every transaction, and it's the same far as other groups are concerned. Every transaction coming from that stockbroking firm does not mean it is their controlling interest party is selling.
Correct.
Yeah. Also, Dushan, now again the market have come to the January all-time high levels also. So I think people are having a bit of a concern. They're worried whether the market will come down just like in January. January the market came down. January market went up, and February and March the market was down. So would you like to discuss about what happened in January, February, and March? Basically, that will help the investors to get an idea about the current context and what happened in January also.
Well, in January, some freak situations happened. One is there were 19 splits. Then the investors and some stockbrokers speculated that groups which did not give splits also will give splits. I agree, when there is a split, there has to be a liquidity premium, and a small amount of prices have to react in a small way. But certain shares reacted far too much, which was not a fundamentally driven increase. Then there was no reason for certain other group shares to rapidly go up, and then certain people who had those shares, just one or two investors who had lot, they just went on selling because they wanted to switch from one high market cap share to another market cap share. So that was a freak situation, but that was a good learning curve, but an expensive learning curve for some people. So basically, in my morning meetings, I have been going on, telling my stockbrokers, make sure that our investors who borrow from banks and finance companies on margin trading, they do not go above 40%. When prices are high, not more than 35%. We cannot help somebody getting forced sold in another broking firm. We cannot help somebody panicking and selling. But markets take once in a way corrections. But you need to hold your fundamentally sound shares and go up and down these little bumps, right? The key is don't have your margins more than 40%. We, in turn, capital trust securities, we give buying power only up to 25%, so that you will be quite amazed. Even today, thousands of investors are there, but over 50%, we have only 4 investors, small amounts. Most are around 25%. And there is another big amount who made huge profits recently, and their margins went down and have not bought. So the margins are intact, and I hope all margin trading providers and other stockbroking firms are also acting responsibility and don't over speculate, don't go beyond your normal means and get into trouble. If you buy up to 40%, you're fine. You can go through little ups and downs. Then also I want to tell you that as we did the buying side, we have online trading, but we have to also get the investors in a convenient situation as far as settlements are concerned. I hate to see every day an investor who is trading has to make a check and receive a check. Why not put them into margin trading, but use the margin carefully so that you buy only up to about 35%, and also you make your supernormal profit, because with the purchasing power of the rupee going lower and lower because of negative real returns at present, you have to borrow. Actually, you have to borrow up to about 35% to get the maximum profits.
Exactly. Yeah.
Okay.
Thank you, Tushan. Asita, I would like to ask a question from you that is raised by Mr. Rashid regarding Expo. How much of the income is due to the pandemic, and how long could the freight rates sustain? Could the margins of profitability be maintained post-pandemic with the acquisition and growth taking place, considering that the rates have gone up fourfold pandemic levels?
Right. That's a good question. I think that's a concern investors have had since last year. Obviously, the pandemic is causing supply side issues in terms of air freight, cargo supply, as well as in terms of sea freight. So yes, there are disruptions that are causing these high freight rates at present. But what one needs to understand is, like in last financial year, the companies could forward book various volumes with liners and cargo carriers, but that can't be done now. So what happens is they take the current rates and keep a additional yield on it. So this yield, regardless of rates going up and down, will be maintained. So even if rates come down, they'll still maintain that yield. So yes, rates will come down, but we still expect volumes to increase because the US economy is picking up. They are increasing wallet share across origin markets by providing more value-added services. They're moving into new origin markets. For example, Idea Logistics is has a big exposure to Central America, and now Central America is one of the new manufacturing hubs for apparel. Apparel is the biggest sector for export. So it makes sense for them to move into Central America because that's where that's a requirement from their clients. It's the origin market. So these will all enable them to hit larger volumes next year. So even if the yields remain constant and the volumes increase, their earnings will be sustainable. So with these acquisitions on the other side, with the whole trucking segment entering this trucking vertical, it's with various disruptions caused in the US. There are various issues transporting containers, etc. They need this infrastructure for their clients. So by adding these new verticals, they can increase the wallet share across the clients, even in destination markets like the US. So it's very important. So this is how they will ensure earnings are sustainable going forward, by vertically integrating forwards as well as backwards in origin markets and destination markets. So we're not really worried about the sustainability of their earnings. So even if freight rates come down, the volume growth and constant yields, we expect the earnings to be very strong going forward.
Asita, there's a question on the valuation techniques. I think we have touched upon this topic earlier also. I think just to cover this for the ones who are joining us newly into these sessions. From this question is from Kushi Nahagawatta. Why do you value bill? I think this is not only applicable to bill. There are a few other counters also that we look at it from the same angle. Why is it for the valuation? We look at the comprehensive income, and if you are using comprehensive income for the valuation, instead of using the comprehensive income, shouldn't you use book valuation? So
yeah, so it's okay. I think we've addressed this before, but so we don't actually use a TCI multiple. We're just reporting. We're just reporting the multiples on a TCI basis as well. So we look at net earnings multiples, standard PER based on net earnings. But it's also if these revaluations and foreign exchange gains are recurrent. So I think in 2012 the accounting standard changed. Previously it was all included in as net earnings. So then after it was reclassified. So if these are recurrent, I think it's very fair to account for that when you're looking at your valuations. Because if it's one-off, yes, agreed, we shouldn't be really looking at it. If it's continuous revaluations, continuous depreciation of the rupee benefits certain companies, we need to look at that and see how is it valued on that basis as well. So that's what we're doing. Even for LOC has a large business outside Sri Lanka. They have dollar assets of more than 100 billion rupees. So if the rupee depreciates every year by 4% on average over the last so many years and expect to depreciate further, then obviously we need to look at the benefit coming from that. So if we don't account for it, then we're significantly discounting that value. So that's the basis we look at as a reporting indicator. We look at multiples on a TCI basis as well. But as investors, they need to look at both net earnings and TCI. If TCI recurrent, then it's you need to look at that and shouldn't be a significant discount. For example, LOC is trading below 3 times TCI P multiples at the moment. So it shouldn't be below 3 times on any basis. So bill, for example, is 4.35 if I'm not mistaken at the current market rates. So it's significantly discounted given the exposure to other comprehensive income, which is recurrent.
Exactly. Hasita, just like Hasita said, actually, when something is recurring in nature, I think we can't ignore that and we have to take that into consideration, especially for companies like DIL and LOLC that have very large land banks and property banks, both in rupees as well as actually a significant property bank in US dollars. So especially in an environment where the rupee is continuously depreciating, the likelihood of having recurrent sort of translation gains have to be considered for these counters. So we can't only look at the traditional PE, we also have to look at the PE based on the total comprehensive income on select counters.
And just adding to that, Shan, I think one other question that was asked was, okay, why don't we look at a PBV multiple? Yes, it is correct because they have a large exposure to real estate, etc. And the whole business model is buying distressed assets and then creating value and then exiting those investments. And that's usually done on a PBV basis, more or less. So then, yes, it is fair to look at a PBV multiple. And at the moment, the PBV multiples are very low for these counters. Global peers are trading at PBV is about 2, whereas LOS is 1.15, BIL is around 1.35, if I remember correct. So those are discounted on a PBV basis as well. So you can look at, you need to look at multiple multiples on PBV as well as PERs. So we just report those indicators at the moment.
Just also touching on the same topic, now people are of the view that these certain counters are purely it's a rupee depreciation play only, and they tend to correlate it straight away against the rupee. If the rupee depreciates, they buy, and if the rupee is held at a particular price, they might decide to sell. Is it only a rupee depreciation play, or should an investor look beyond that as well?
Yes, Shan. So it is not solely a rupee depreciation play, right? So we have looked at various elements. For example, if you look at Expo, yes, so their P&L will be restated as per the average exchange rate for the financial year, right? So yes, there is going to be a benefit, but okay, it's not significant. So that's not the only reason for high profitability. Same with LOLC, where on a OCI basis, I think we are assuming around a 20 billion gain through translation gains because of rupee depreciation. So if that depreciation doesn't happen, then it will be reduced. But still, there is other elements from the Prasad sale, from the recurring business, which is around 25 billion. It has around 25 billion rupees of recurring earnings. Then a bill has brings in about 16 billion of earnings through net earnings this financial year. So there are other elements. So it's just not translation gains and benefits from rupee depreciation. So those all need to be looked at, not just the rupee depreciation in isolation. So the rupee depreciation on the current environment is something that we ask investors to look at because it's favorable for various counters, but it's not the only favorable element. So you need to look at all these, the whole operating environment, see what's happening, see what are the other benefits. If there are other benefits and net earnings are increasing as well, so those all need to be factored in. So it's not, you should just look at the translation gains and the rupee depreciation in isolation.
Right. Divya, you have to unmute yourself.
Just to add to that as well. So like Hasita mentioned, so I mean the depreciation is just one element. So most of the companies that we are actually recommending also have a very strong growth story. So if you look at Expo, I mean, you know, the sort of the revenue is largely supported through volume growth and elevated rates. If you look at counters like, you know, MGT, you know, we have actually considered things like the capacity enhancements. They have actually grown their capacity additions by 83%. So that's a significant growth story. Same with TJL, they are expanding, you know, to enhance capacity by 25%. So we are, I mean, the depreciation, yes, it is an element, but it is definitely not the only element that we're looking at. We are actually looking at the, you know, the industries that the companies are operating, what is going on there, what is also the growth story associated with the company. And we carefully analyze all of that information as well. And with regard to the exchange rate, I think, like we mentioned, we actually, even for forecasts, so we have looked at about 215 rupees. So we take the average exchange rate. So we've taken 215 rupees for financial year 22 forecasts. So just to answer your question, Shehan, it is not the only element that we look at. It is one of many. But we give a lot of, actually, we give a lot of prominence and sort of do in-depth research in terms of the industry as well as the company specific, you know, sort of risks and growth factors when we come up with the research reports and webinars.
Tushar, if you see, social media has become the most influencing factor for the share price to go up and come down as well. If you really see, some before they, after they buying a particular share, they say they bought a share, and people who are being following or people who are in the same social media platform started buying. And if they sell, they won't sell, but after selling, they will say that they have sold. So there are positives in the social media as well, and there are negatives as well in the social media. How that is influencing in CSC?
That question, social media is a good thing so that there is a communication channel free of charge. However, the users of social media need to be educated, knowledgeable enough to know what to believe and what not to believe. So what we have done is, we are telling not to believe anybody. We are saying, please, I mean, we are, you know, we have on Capital Trust YouTube channel, we have put a a video on learn fundamental analysis. It's also there in our website. Then we have also translated into Sinhala and put again. So we expect every investor first to learn fundamental analysis. Thereafter, we have also put in English, Sinhala and Tamil, learn online trading, a very, a slim, up to the point video, so they can learn. So then weekly we send the ratios of about 160 stocks. They can buy low P ratio, low price to book value, high return on equity stocks, and high dividend yield stocks, and decide for themselves. So what is the need of listening to what someone else did? Why is anyone following anybody? Make your own decision. Then once you decide on 7-8 stocks what you have decided to buy, for timing you get guidance on about 7-8 technical tools. And we don't use one tool, we send about 8 tools daily, so that you get an idea what various tools also say. Then finally, it's you who make the final call, and you need to place the order. Then another thing which is related is some people think you need to buy shares with dividends, not buy ones without dividends. And actually, in our previous webinar, we showed a slide where the highest market cap companies in the world are companies which did not pay dividends. And that is because they keep all the capital for future expansion, and therefore they grow. Basically, if the company can grow the money in many countries better than what you can do, you must let the company do that without paying you dividends, and you just spending it away once in a way. And end of the day, you need a monthly income and not a 6-monthly income. So therefore, when every month you can sell part of your capital gains for your monthly living. You can't be waiting for 6 months or 4 months to get a dividend. So end of the day, we also had a presentation where we showed you need to look at maximizing total return, that is capital gains plus dividends, and it is not maximizing only dividend yield, because end of the day the dividend yield may be high, like we showed in a slide, but the total return may be even negative. Yes.
Just adding to that point what Tushar mentioned, basically, I think these high dividend yield stocks, what happened in the past was they were trading, when foreigners look at various counters in the market, they'll look at various foreign funds, they'll look at various global peers, regional markets where they certain consumer sector stocks will trade at high PEs, like 25 to sometimes even 30, between 20 and 30. So even in Sri Lanka, certain FMCG stocks were valued on that basis. But when foreigners exit, locals don't value local investors don't value those stocks in the same manner. So that's why even for Expo, we're assuming a discount to global peers, because that's how local investors value stocks at the moment. So these stocks, these FMCG stocks that were priced at a very high multiple before, are now being re-rated lower. So that's why there won't be capital gains. There won't be certain capital gains that we're saying there are negative returns on that. But there's a high dividend here. So investors need to make a wise decision there when you're looking at total returns.
Right. Tushar, hello. Tushar, you have to unmute yourself. Tushar?
We find stockbrokers every few hours asking our stockbrokers, what is happening in this company? Why is it come down? Why is it going up? Well, there's nothing happening in those companies. Every 3 hours, the normal course of business is happening, and the events which are going to happen will happen. Events which are not going to happen will not happen. So, but you all have forgotten, when you go and put a fixed deposit, it's either 3 months, 6 months, 12 months, 24 months, or 36 months. In the same way, when you are coming to the market also, you need to take a 3-month view, 6-month view, 12-month view, likewise. So, and in between, once you take a firm decision, don't get like every 2 minutes, don't look at a share and get highly excited. The company will do a random walk and go where it has to go, right? You have to believe in the fundamental science works, technical analysis science works, and dollar depreciation. If there is dollar depreciation, economic problem, then you need to, through the market, invest in other destinations, other countries, and you must believe in these simple sciences. And you need to take a 3-month view or a 6-month view or 12-month view or even a 24-month view. But you can't take a 2-hour view or a 2-day view. It doesn't work. You just become you make a mess of yourself and the market.
Exactly. That is what actually happening right now in the market. Everyone expects their counters to go up each and every day, at least 2%, 3% each and every day. Share price has to appreciate for them to be very happy. So that is why.
Rakesh, I also want to tell you all that companies can't do magic. Undervalued shares, you'll find once in a way something, and it will quickly re-rate. But companies can't do magic. Companies have to put your money into productive use and make profits, right? So investors also should not think that companies can make magic, expect very high gains every week. No, if you try to do that, you're speculating and you'll make a mess of it. Take like the fixed deposits, you take a view and do very much better than the fixed deposits. That's my advice.
One last question from my side to Hasita and Divya. Again, clients have been asking questions about BIL and LOLC's fair value. I know that you are categorically not giving fair values for those two counters. I would like to reinstate again, what is your view about the fair value of BIL and LOLC?
As we said in our last webinar, we still don't want to comment on the fair values until certain key events that we've highlighted in our previous webinars come into actually happen. But what we would like to stress upon is, if you look at the forecasted earnings and the current multiples, it's extremely undervalued. So that is the sentiment that we want to convey at the moment. We don't want to give a fair value until these events occur and we do a proper coverage initiation on those counters and actually come up with a fair value. So I don't think it's really fair to do that on this webinar. But in the future, we will be doing that. So we'll have to wait till these events happen and we totally understand the impact on the P&L and balance sheet from these events.
So I think we've had a very fruitful session today. Tushan, do you have any final remarks to add before we close the session?
Yes, I must say that what drives the stock market is the low interest rate regime and politically difficult things like the tax amnesty. Then there is also going to be a Residencies Act where you invest certain amounts, diaspora can get they will have to invest part in real estate, part in capital markets to get their 5-year or 10-year visa. So these are things which we have never seen. And also we have never seen a situation where there has been full digitalization, where you can open a CDS account in just 15 minutes digitally without paper. Then the foreigners who are overseas by opening accounts, we have not even seen it. Our computer systems are not ready to take much more people. Then the fund transfers in and out to stockbroking firms and custodian accounts are all happening electronically. Everything is quite smooth and efficient. There is social media, which you need to use properly and take what has to be taken from it. And we are happy that we have empowered the clients in showing them how to look at fundamental analysis, technical analysis, and we are keep on keeping webinars. We are having it transparent so that we are opening it for questions, so that if any particular line is incorrect or wrong, they could ask. We can directly ask, reply at the webinar, or later by email, we can reply. We have a hotline where we can help. And end of the day, what I'm over and over again reiterating is the customer is king. The king has to take his own decision, and the customer has to we have empowered the customer. Please use all these tools and make your own decision. Don't follow the herd. Don't look at the all share index every 5 minutes and decide whether you want to buy or sell. You look at your basket of shares, whether your basket of shares in A-Trade is going up or down. That is your basket of shares. Don't look at the 200 companies which might have lost its way, right? So don't buy the market, buy a selected set of shares and have confidence in it. Go through small ups and downs, hold on very firmly. You will make a lot of money. Thank you, Shahan. I think it's time up.
Yeah, thanks a lot, Tushan. I think I don't have to add anything to that. I think Tushan carried a very important message to our investors. Basically, you are the engine of this of the stock exchange. So it's important that you all are educated. So this is not a winning lottery ticket or a T20 match. It's not that. It's an educated investment decision. So like Tushan mentioned, know your reasons why you're buying a stock. And the whole idea of these webinars is to give those reasons to you and to clarify any doubts if you're having. So, so on that note, I would like to end this session, today's session. Thank you, Divya, for your excellent presentation. And thank you, Hasita also, and Imalka, Rcl for all the value addition that you all are doing to get the research right. And thank you, Rakesh. And most importantly, thank you, Tushan, for facilitating this webinar. And also thank you. I would like to thank the investors for devoting their time on a weekend to join with us. So we would be doing more and more webinars like this to educate you all in future. So thank you everyone. Have a nice day. So with that, we'll be closing this session. Thank you.